All right, thanks so much to the organizers for including this paper in the program. It's a pleasure to be here. So today I'm going to talk about how changes in interest rates affect the way banks fund themselves, and then how this fits into their lending decisions, and then translates into firm-level outcomes like investment and new firm creation. So the motivation for this paper really comes from 3 pieces of stylized evidence that I document in the paper on the relationship between interest rates, bank balance sheets, and what's been happening on the firm side. Okay, so let me start with the first one. So one of the starkest trends over the past 40 years or so has been this steady decline in interest rates. The level of the Fed funds rate, that is the interest rate I focus in this paper, fell from about 20% in 1980s down to closer to 0, and more recently has been going up. Now, what I document in the paper is that as the rates have been falling, there were 2 very key shifts on banks' balance sheet. The first shift that happened was on bank liability side. So think about bank using 2 major sources of financing. They either use liquid deposits like savings or checking deposits. Those are demandable deposits. Or banks usually use illiquid deposits like time deposits, CDs. Those are contracted for the term and cannot be withdrawn before the end of it without the penalty. So here in red, I plot the share of banks' financing coming from these illiquid time deposits. And what's striking is that time deposit financing by banks very closely tracks the level of the Fed funds rate in every single of the Fed cycles, but also over the longer horizon. So as the rates have been falling, banks were effectively running out of time deposits. They fell from about 50% of banks' assets in 1980s down to closer to 15% more recently. And during the recent tightening cycle, we observed them going up again in importance. Okay, the second shift that happened is on banks' asset side. So here in blue, I plot the share of banks' assets invested in commercial and industrial loans, C&I loans. So those are loans to firms. And again, what's striking, you can see this strong co-movement between interest rates, time deposits, but also business loans. Again, in the cycle and over the long horizon, as the rates have been falling, banks were losing these time deposits. The assets invested in C&I loans shrank from about 30% in 1980s down to closer to 15% more recently. Now, the decline in the quality of business loans can reflect both demand or supply forces. Maybe it's just that firms demand less and less of bank loans. They shift to other sources of financing. So this is, this demand-supply story is going to be the main challenge that I'm going to try to tackle in this paper. But even in the aggregate, we can make some progress to understand what has been going on. So one way to think whether it's demand or supply is to see what happened to the price of these loans as the quantity has declined. So what is the price of these loans? Well, it's effectively the spread that banks charge on these business loans. And so I plot this spread here for C&I loans over the past 30 years or so. And what you can see is that mirroring the decline in the quantity of business loans, that there has been a steady increase in the price of these loans. This has been previously documented by the papers, for example, by Roberts and Schwerd. And what I contribute here is that to combine is sort of quantity and the price response sort of moving in opposite directions, suggesting that there has been some role for the supply factors along the way. Now, this spread has been also falling as the rates have been increasing more recently. Okay, the final piece of this aggregate evidence comes from the relationship between the quantity of business lending and firm-level outcomes, like investment on new firm creation. So I plotted in this picture, and what has been previously documented in the literature, for example, the paper by Gutierrez-Filipon, that there has been this steady decline in firms' physical investment over the past 40 years. But what is kind of striking is that this decline in investment came along the way, this decline in the quantity of business loans that have been moving very strongly together. Well, maybe you don't find it surprising because obviously firms need some source of external financing to finance this investment, but this relationship doesn't hold, for example, for bond financing of firms. Okay? And similarly, when I look at the new firm creation, we have long literature documenting this decline in business dynamism that happened along the same sort of trend as the decline in a quantity of loans. So motivated by these sort of 3 pieces of stylized evidence in this paper, I ask sort of 2 simple questions. First, I try to revisit what is really the effect of lower interest rates on the way banks fund themselves and how this impacts their lending to firms. And second, what are the implications for firms, outcomes like investment or business dynamism. So the paper has two parts, the empirical part and the theory side. On the empirical side, I'm going to provide a battery of tests coming from the cross-sectional data on banks, firms, and geographic areas in the US. And sort of as I already alluded, there will be two main identification challenges, right? So the first one is kind of obvious. It's that interest rate changes are endogenous to economic activity. So I'm going to zoom into these FOMC announcements and look at the high frequency changes in interest rates that were estimated from the Fed funds futures data or Taylor residuals. And this is kind of the similar approach as in the recent paper by Kroen, Liu, Mian, and Sufi that look at the impact of falling rates on the rising concentration. The second challenge is this demand versus supply. Okay, and I'm going to rely here heavily on the cross-sectional data on banks and exploit the variation in bank market power in deposit markets to try to see how this bank market power and the amount of deposits that banks get translates into their lending decision. So on the model side, I'm going to build and estimate a structural G model, and at the core of this model will be a dynamic portfolio problem of the bank at both liability side and the asset side. So banks will be optimizing across different funding sources and different assets that they can invest in. And banks will be engaging in both liquidity and maturity transformation. And I will use this estimated model to quantify the effects of long-term decline in interest rates on equilibrium outcomes such as lending and investment. So before diving in, let me just give you a brief summary of the results. So on the empirical side, I'm documenting 4-piece chain of events. So the first result is just thinking, how does the Fed monetary policy affect banks' liability side, so banks' funding mix? And I find that lower Fed funds rate leads depositors to substitute away from these illiquid time deposits into more liquid savings and checking deposits. Now, why is it important? Well, it turns out that banks actually actively match different deposit and asset types, and they very closely link the amount of time deposits they have with the business lending they are willing to provide. Why is it happening? I'm going to be very clear about it, but think about it as sort of risk management type of story when banks are trying to match interest rate sensitivity and liquidity properties of their deposits and assets. Now, the third result is just the sort of implication of the first two, where I look at the impact of the Fed monetary policy on what happens on banks' lending side. So I find that lower Fed funds rate leads to an outflow of the time deposits, and as banks use time deposits to finance business lending, they effectively reduce the supply of business loans as the Fed loosens the monetary policy. Now, you may find it very surprising because there is long literature highlighting bank lending channel, sort of how lower rates feeds back into banks' decision and increase banks' lending. Well, this is kind of an incomplete view. Actually, there is a lot of heterogeneity on banks' asset side when we zoom into different asset types. And in fact, an earlier literature already highlighted this puzzling response of C&I loans to monetary policy, that they're actually falling when Fed loosens. So my paper contribution here is to actually reconcile this puzzling response and put sort of stress on the role of bank supply in explaining these results. So the final empirical finding is on the real effect. So I find that the decline in the supply of business loans contributed to a fall in investment, especially for firms that are bank dependent, that rely on banks and don't have access to, let's say, bond market. And second, it led to the decline in new firm creation in industries that are actually highly reliant on external financing. Right, so on the model side, I estimate the model and find that this time deposits channel is actually quantitatively very important and can account for a substantial decline in things like quantity of loans or investment. Now, because of limited time, I'm going to focus exclusively today on the empirical part of the paper, and kind of provide you with some intuition what's going on, and kind of break down all these 4 main findings and provide some evidence supporting them. Okay, so I'm going to start with the liability side and look at the impact of the Fed funds rate on bank funding mix. Okay, so again, I want you to focus on these 2 major deposit categories, the savings and checking deposits, the orange deposits. Those are the demandable liquid deposits. And then banks also use time deposits, CDs, Again, those are the illiquid ones contracted for the term that cannot be withdrawn without paying the penalty. Usually, think about them as 1 year to 2 year deposits. All right, so I find that actually there is a very strong link between the level of the Fed funds rate and the type of deposits banks have. And you will see, you can see it across many sort of slices of the data. You can look at the sort of dynamic response of bank liabilities to high frequency changes in the Fed funds rate, but it's very clearly visible even in the aggregate. So here I plot the evolution of time deposits and savings deposits against the changes in the Fed funds rate. So what you can see is that for the time deposits in the left panel, there is very strong positive relationship between Fed funds rate and their growth. So whenever the Fed effectively rises the rates, banks experience an inflow of time deposits as during the recent tightening. Now, on the flip side, banks are losing savings and checking deposits when Fed tightens. And this is exactly what has been happening in the past 2 years. But again, it's every single cycle looks basically the same way. So when Fed fund rate changes, sort of banks' funding mix is effectively affected by that. Now, why is this happening? Now, this can be easily explained through the deposit channel of monetary policy type of story by Drexel, Savov, and Schnabel, now extended to more deposit categories that differ in liquidity. Okay, so their focus is mostly on just total deposits. Here I split them into time and savings deposits. In the paper, I provide a formal framework to kind of explain it, but let me give you just a brief intuition what's going on. All right, so we know from the deposit channel work that banks have market power over their deposits, and the amount of market power they have depends on the level of the Fed funds rate. Okay, so when the Fed funds rate goes up, banks, the opportunity cost of liquidity, the liquidity premium goes up, right? The opportunity cost of holding cash goes up. Banks internalize it. Banks' effective market power in providing liquid savings and checking deposits goes up. So how do they respond to that? Well, they increase the spreads that they charge on these liquid savings and checking deposits. And you can see it, you know, we all know our savings deposit rates barely moved over the past 2 years. Now, time deposits are more illiquid type of deposits, and banks need to compensate the depositors for the lack of liquidity, and they increase the rates on time deposits more in line with products like bonds, so more in line with the market rate. And that's exactly what we see. The time deposit rates move very much in line with the market rate, right? So, you know, this is kind of the place I want you to stop and kind of reconcile sort of these two features, the liquidity and interest rate sensitivity, right? So even though we think about time deposits as fixed rate, because they are contracted for the year, their effective sort of rate sensitivity is actually very high. And this is in contrast with savings and checking deposits that are effectively overnight demandable deposits, but their effective duration is actually very long. The rates, the cash flows that banks pay on these deposits is very low. And that's going to be crucial when thinking about this interest rate sensitivity matching. All right, so again, so when Fed fund rates goes up and the spread between time deposits and savings deposits open up, you know, the depositors internalize it, they economize on savings and checking deposits, and they substitute away from liquid into more illiquid time deposits. Now, why is this important? Why does it matter why banks have liquid or illiquid deposits? So it seems to matter very much because I find in the data that there is this very close link between different deposit and asset types. So specifically, there is this link between time deposits and business loans, and between savings and checking deposits and more long-term lending by banks. Okay, and you can see again this matching across sort of many dimensions and many slices of the data. But the most sort of visible way to see it is just looking at the dynamics of C&I loans and time deposits in the left panel. They effectively move one-to-one. The similar picture holds for savings and checking deposits and more long-term lending by banks. Now, one thing you may worry about is that this is all driven by just aggregate balance sheet movement by banks. Well, if this was the case, if I swap the series, you know, they would be, again, strongly correlated across these different asset and deposit categories. But actually swapping the series leads to, if anything, a negative relationship between, let's say, time deposits and long-term lending, suggesting that the marginal source for long-term lending is not really a time deposit. Now again, another worry may be that this is all driven by just few large banks that drive this aggregate series. Well, we can break it down and look at the cross-section of banks. So here in the left panel, I compare the changes in time deposits and the changes in C&I loans now at the bank level, and I compare the two in the cross-section of bank in the form of Bing scatter plot. Again, you can see that this relationship holds not only in the aggregate, but also at the bank level in the cross-section of banks. Similarly for savings deposits and long-term lending. Now in the paper, I also zoom into more sort of identified changes in the supply of deposits coming from the deregulation period in Reg Q era. So for example, one of the experiments I look at is the deregulation of small time deposits, where when they became deregulated, banks could pay a market rate on them. And what happened is effectively banks with a stronger ex-ante reliance on time deposits, they observe a larger inflow of these deposits. And what happened? Well, they invested them into these interest rate sensitive assets like C&I loans. And completely opposite story happened during the deregulation of savings and checking deposits that were, when they became deregulated, they were invested effectively in long-term lending by banks. All right, so why is this matching exactly happening? So I argue that banks do it for two reasons: the interest rate sensitivity and liquidity properties matching of these two balance sheet items, the deposits and assets. So what's about this interest rate sensitivity matching? Well, this kind of goes back to this picture that I showed you on how deposit rates are sensitive to changes in interest rates. Well, C&I loans are primarily floating rate assets, so their cash flows are highly sensitive to the changes in the Fed funds rate. Well, time deposits, again, even though they are effectively fixed rate, we saw from the picture before that their effective sort of duration is actually pretty short. Banks, the rate resets every year, and banks tend to pay a market rate. So their rates are more sensitive to the changes in the Fed funds rate compared to more liquid savings and checking deposits that have effective duration that is way longer. And so effectively what's happening is that financing C&I loans with time deposits hedges this interest rate exposure of banks. And you can see it all in the aggregate and in the cross-section. So in the aggregate, I plot the effective rates banks pay on time deposits against what they receive on C&I loans. And again, this is kind of the picture that they move one-to-one. And this matching also exists in the cross-section. So while on average, we estimate the beta of the interest expense that banks pay on time deposits to be very high, it's also pretty high for C&I loans. And banks with slightly more interest rate sensitive time deposits, they also invest in slightly more interest rate sensitive C&I loans. Now this is what the data tells us. Now we can also ask banks what they talk about, right? When we actually look at some statements that banks make about how they manage this interest rate risk, well, this is kind of what they confirm what we see in the data. So they say that their policy is to match interest rate sensitive liabilities such as CDs with interest rate sensitive assets such as commercial loans. And they do it because they want to keep this relatively constant profit margin, and that's what they really care about. Now the second reason for this matching is liquidity, right? So the C&I loans are very illiquid, right? They are, in the literature, considered one of the most illiquid assets that banks invest in, very hard to dispose of to meet liquidity needs. Now, time deposits are kind of by definition illiquid, right? They are contracted for the term, and usually the depositor will keep the deposits for this contracted term because otherwise they will incur some penalty. So matching these two hedges banks' liquidity exposure. And we can see it through this cross-sectional graph where we zoom into the time deposit maturity at the bank level with the maturity of C&I loans they are making. Right? This is not duration matching. The duration of C&I loans is 0. Time deposit is their effectively maturity. And we see that banks with slightly longer time deposits will invest in slightly more illiquid C&I loans. Right? Now, this matching is not perfect. There is not one-to-one map between maturity of time deposits versus C&I loans, but on the margin, it seems to matter. All right, so now let me shift gears and move from liability side to the asset side of bank balance sheet and look at the impact of monetary policy on this sort of allocation on the asset side. So what am I going to do? Well, I'm going to resort to this local projection type of exercise that will allow me to zoom into the changes of different balance sheet items at the bank level to changes in monetary policy that can be instrumented either with high-frequency monetary policy surprises from the monetary econ literature or just Taylor rule residuals. And I'm going to be looking at these four main balance sheet items: the real estate loans and securities, savings and checking deposits, CNI loans, and time deposits. So let's see first something that we are used to seeing. So in the left panel, I plot the response of the long-term lending by banks. Okay, so those are the real estate loans and bank securities, so think about them as mortgage-backed securities, effectively. That's where most securities banks invest in. So that's in response to the higher rates, banks are shrinking their long-term lending. So real estate loans and securities are falling. Why are they falling? Well, this is kind of the deposit channel that we are used to seeing at play. They do it because they are funding them with savings and checking deposits that are flowing out when Fed tightens. Now, on the flip side, there are these CNI loans. So CNI loans actually are going up when the Fed tightens the monetary policy. And again, this is, for some of you, may be surprising, but actually it's been a known puzzle in this literature for quite some time. And what I'm trying to argue here is that they are going up because banks are experiencing an inflow of time deposits, and they are using time deposits to finance CNI loans. Now, this is just an average response at the bank level. We can also look at the cross-section, so estimate this dynamic coefficient across banks and compare them, and we see this very strong matching as well. So banks with larger inflow of time deposits with Fed tightens will also invest more in CNI loans. Now, this is just a response of the quantity of business loans. And there is this worry, obviously, that this may be just driven by demand. So banks may be experiencing some better lending opportunities. The loan demand may be going up. So while they are contracting time deposits that are effectively marginal source of funding for them, and they are lending it out. Now, so throughout the rest of my talk, I'm going to try to argue that these are actually supply forces at play here. So one way to think about it, whether it's a supply or demand, is to look at the response of the price of this loan. Right? So in the left, I plot the response of quantity going up, but the price is actually falling. So the spreads on these loans are decreasing, suggesting on net an effect on the supply. Now, we can zoom in into the recent period of the monetary tightening in 2022, 2023, and actually a very similar picture emerges. So that when the Fed tightens, time deposits are flowing in, CNI loans are going up, the spread is falling, again kind of suggesting this supply force importance. Now, to sort of more strengthen these supply forces, I'm going to now resort to some cross-sectional evidence. Okay, so the main identification challenge, as I already alluded, is the fact that this time deposit supply can be just responding to changes in bank lending opportunities that may be, puzzlingly going up when the Fed tightens, and rather than directly to these supply forces that I'm trying to argue. So I'm going to take a three-step approach to kind of try to disentangle sort of closer these forces. So the approach I'm going to take is first I'm going to exploit this cross-sectional variation in bank market power in deposit markets. So the idea here is to proxy for bank market power with some known instruments that were presented in the literature. So think about it as sort of the deposit HHI in the local deposit markets, or just financial sophistication of depositors that banks are borrowing from. And now what I see is that banks with effectively higher market power are going to increase time deposit rates by less, and as a result contract fewer time deposit when Fed tightens. Okay, so this instrument provides me sort of a cross-sectional supply shifter that will allow me to see banks with different amount of deposits as the Fed tightens. What I'm going to do next, I'm going to use some more granular credit data that will allow me to control for time-varying demand factors with fixed effect, sort of the Khwaja-Mian identification. And I'm going to look into both small business lending and syndicated lending to zoom into this demand versus supply forces. So I'm going to be looking effectively at these two banks with different amount of market power in their deposit markets, lending to the same county or the same sector or the same firm at the same time. So effectively controlling for bank lending opportunities. And I'm going to combine these two and look at the response of both quantities and spread to changes in monetary policy in this cross-section of banks. All right, so for the sake of time, I'm going to just show you some results on the syndicated lending. So I'm going to look at the response of loan quantity and the spread. Again, in the cross-section of banks in terms of their market power, here proxied with banks HHI in local deposit markets, two changes in interest rates. So in the first and fourth column, again, shows that when the Fed funds rate goes up, the quantity is increasing and the spread is falling, suggesting the increase in the loan supply. Now, this loan supply increases by less at banks with more market power in deposit markets, so those banks that are able to contract fewer time deposits. And these coefficients stay very robust when controlling for some of these additional time-varying demand factor, whether with sector time or firm time fixed effects. Okay, just the final piece of the analysis is to look at some of the real effects. So for the sake of time, I'm going to just focus on firm-level investment and firm-level borrowing. All right, so I'm going to be splitting firms into two types. So looking at the cross-section and thinking about the red firms. So those are the firms that are bank-dependent. They don't have access to other sources of financing. And the blue firms that can access the bond market. So they can effectively substitute towards other sources of financing when faced with, let's say, a bank supply shock. Okay, so I'm going to proxy for bond market access in a number of ways, but for today's talk, I'm going to just look at the availability of rating. So firms that are rated can quickly go to the bond market to substitute. All right, and I'm going to look at a bunch of firm-level outcomes, such as the bank borrowing, the bond market borrowing, total firm debt, and firm-level investment. So in the first row, I'm looking at the response of these outcomes for firms that are bank-dependent. So they don't have access to the bond market. And what I see is that when the Fed funds rate falls, these banks experience a decline in bank lending. So that's kind of what we know from before. And effectively, their total debt is falling, and their capital investment is also declining. Now, the blue firms, the firms that can go to the bond market, they also experience a decline in bank lending, and they substitute it by going to the bond market. So on net, there is no change in total debt and total investment for them. Now, there is some heterogeneity even within the firms that are rated. The highest rated firms that solely ride on the bond market, they actually ride this softer monetary policy, and for them, we see an increase in investment. In terms of some of the elasticities, what I find is that the effects are actually quantitatively pretty strong. So 1 percentage point decline in interest rate leads to a almost 2% cut in credit and 1% fall in investment. All right, so let me wrap up quickly. So 3 main takeaways from this paper. First is that, in this paper, I document this new channel of monetary transmission for time deposits that shows that lower interest rate leads banks to lose and experience an outflow of time deposits, and as they are using them to fund business loans, it leads to a decline in the supply of these loans to firms. Now, second, this provides a new perspective on sort of these long-run implications of falling interest rates that many people in macrofinance have worked on. And I find that this decline in interest rates contributed also to things like the decline in investment and new firm creation that we observed over the past 40 years. Now, in terms of broader implications and some open questions, these channels, while in this paper I focus just on C&I loans, it actually can be more generalized to other types of assets, and thinking about sort of composition of mortgage lending between adjustable rate and fixed rate mortgages, that seems to actually play an important role which type of financing banks have. Now, this decline in the supply of business loans also led to some other phenomena that we observed in the past 15 years. For example, a rise in CLO. So I have some ongoing work that studies this question as well. Thank you so much, and looking forward to today's discussion.